Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go into and talk about the market conditions. The market conditions are what prices assets. We can talk a little bit about inflation, deflation, if the Fed can successfully stop the inflation. And I'll give you my financial opinions around it. But there's a couple of drivers that I think are out of the Fed's control. They're trying to slow things down, but I'm not sure if they can actually stop the move. And I'm going to go into all those things of why I think that. So the one thing that I think that they can't stop is the supply-demand fundamentals, given the demographic that's coming into home buying years. And that's why I keep going back and why I'm so reluctant to say that house prices can substantially fall. I was looking on Twitter. We can go over a couple of things as well. And if you guys haven't added me on Twitter, you probably should. It's at @finding_finance. Definitely check out a lot of the stuff that I retweet or what I tweet myself, because there's a lot of important information that is being shared that I think will make you a better investor knowing it. So let me go over a couple of things here real quick on what's going on. And it looks like Dave Ramsey agrees home prices are not going down. And what he does, he steps through the demographics, basically. It's nothing foreign to anyone who's been on the channel for a while here. We've gone through the data. And what I think other people are misconstruing with the data is they look at things that just don't matter. They're not looking at the right thing. So when I look at the data, and I don't know if anyone has this exact data, the data that I look at is, and what we want to find is how many willing and able home buyers there are in relationship to the demand or the supply of those homes. So it's that ratio. And there's been a lot more households that have been formed in the millennial age group, which is the largest demographic, than any other demographic. So I understand that the counterpoint of the argument is that baby boomers will be dying off, the homes will become available, and there's so many homes coming from that demographic that we're not able to absorb the homes from that demographic. And I disagree with it. I don't think that that is necessarily correct. I think that the demographic in home buying years, which is now, is far greater than the baby boomers, dying off and having homes available to either be purchased or inherited. And it looks like Dave Ramsey is very much in the same agreement as me. It's just one person. It doesn't matter who's in agreement or not, but that's the data that I have found to be true. And the reason this is so important is home prices and new homes coming into the market, and the volume of homes that come onto the market is at least historically, has been a driver of inflation. And interest rates doesn't stop that dynamic. It can slow things down, it can slow the affordability down, but it puts the Federal Reserve into a predicament where it's not a problem. A problem has solutions. A predicament has outcomes. So I think it puts them in a predicament, because if they try to slow this move down, which is demographic driven, which is demand and supply, much like we saw in the 1970s, it was the baby boomers coming into home buying years, it was inflationary, and there was restrictions in the system given the supply of energy. So I'm going to try to tie a whole bunch of different information together here, so just bear with me. So we had a larger demographic in the 1970s. They came into home buying years. It was inflationary because of all the homes that were built. And you can see that through the housing starts. The housing starts ramped up dramatically. And with those housing starts ramping up, what we saw was a dramatic increase in the inventories. Well, right now, we haven't ramped up our housing starts. We're ramping it up, and we have a lot in the pipeline. That's what they talk about with the new homes inventory. They're not for sale homes that are built and complete. These are homes that are in the process of being built, and there's a lot in that process. And what the Federal Reserve, I think, is scared of are those homes coming onto the market and the loans going against them. that will be inflationary. At the beginning of this, they did a bunch of stimulus, which was highly inflationary, and they basically pumped the system with a bunch of cash to begin with. So they pumped the system with a bunch of cash during an expansionary phase of real estate, where the demographics are driving the demand and supply of homes. The rate of increase in mortgage rates has been dramatic. We've gone from 3%-ish interest rates all the way up to greater than 7%. And that has slowed stuff down, but it's the market trying to digest all this, I think. And I know a lot of people will say, well, you can't afford it. People can't afford it. The average person can't afford it. There's not enough homes. They're trying to price everyone out because the homes don't exist for the average person to own it. And that goes back to the demand supply. The demand, how much able, willing buyers are there in relationship to the supply of homes? And if your inventory levels are incredibly low, 4 months or so, 5 months, 4 months, somewhere in that range, whatever it actually is, it may be 3 months, that's where it's difficult to know exactly what that number is. The available buyers versus the available sellers. And the only way you can really do it is look at the inventory and what the inventory is doing. That is your balance of supply and demand. So is the balance balanced out? No, it's not, because you've got low inventory still. It's slowing things down, though, the interest rates, for sure. 100% agree. And that's something that we have to monitor. Now, if you look at the 1970s to do a comparison, we had a demographic that had a big kind of collapse and then it came back up. The demographic, I think, is what drove the inflation numbers and the money into the system. And the interest rates followed along with it. The interest rates didn't stop it in 1982, that inflation. It was the demographic running out. But here is a new situation that's coming up. So just keep that in your head. The demographic is what kind of kept that thing going. If the demographic continues to put the housing market in a out of balance situation where the house prices have to price people out of the market given how many homes there are in relationship to the demand, what that's going to do is it's going to put pressure on the system as new homes come online that are built, and new loans, the volume of those loans going against those new homes come in. It will still be inflationary. And that is a driver that the Federal Reserve cannot, I think, solve or fix. They're put into a predicament because interest rates are a function of the relationship of inflation versus the interest rate that's out there. And if it's a large real negative rate, bondholders will sell their bonds because they're not getting their money back in purchasing power, gains. They'll sell, and that selling pressure will drive interest rates up. Now, that puts the Federal Reserve in a tough spot because if interest rates are higher and they have to release bonds to the market to fund whatever it is, and given the amount of debt that they have, they're going to have to print money to cover any sort of imbalance there is in the market. And if interest rates move on higher and they stay high for a long time, then they're going to be put in a difficult spot because now you're going to have less buyers that want those bonds at certain interest rates. And with the interest rate going up, their interest payments go up with it as well. So they're put in a difficult spot because if they need lower interest rates, they have to print money, buy bonds to hold the interest rates down because they need greater demand for those bonds. And that's where it puts them into an inflationary situation where they're adding more inflation into the system on top of a demographic that's already adding inflation into the system. So they're getting hit multiple times from an inflationary standpoint. And I don't know if there's a way to actually stop it because the demographic is there being persistent with that shortage. And there's the debt that's also there, which really limits their abilities to do anything. not that they can really do anything about it anyway. It's just going to limit what they can do from an inflationary aspect, because they're going to have to print and buy bonds if they want to try to hold that interest rate down, which they probably can't. Now, the other part of this that makes it even worse is historically, as these imbalances in the market, and that's what we invest in. We invest for imbalances. There's large imbalances in the market outside of the inflationary aspect of it. It's all on the supply side. And I don't think the Federal Reserve can do anything about the supply side, which could make things worse with higher interest rates as well. So the supply side, we've got the demand side and the money side. The money side, the inflation side, I'll say, is a driver that puts everything into a shortage. More dollars chasing fewer things. That is inflationary. Now, we're going to look at the supply side, because the way that you solve more dollars in the system to keep the system in balance is to have a supply side response that matches the inflation in the system. So it's solved through supply. But if you have supply side constraints, then you have a problem, because you're going to get massive inflation through the consumer price index. Not just inflation from dollars in the system. It's the balance between dollars and GDP, or balance between dollars and whatever stuff is out there. That is what will be inflationary. We are stuck on the supply side, I think, of energy. We're hitting constraints in the system. We've got Russia that basically pulled on back, and the demand for oil continues to skyrocket higher over time. And as that demand continues to increase and you have supply side constraints on a global basis, that will be what translates that inflation we were talking about with the predicament that the Federal Reserve is in with their bonds. And if you don't have buyers, they're going to have to buy that stuff, which is inflationary. And the demographic that's driving in the housing real estate market, which is also inflationary. But if you have no supply side response, that's where things get real interesting, because it's like the 1970s when we had a peak oil in America, a constraint, but we grew into the globe. The globe I don't know if it's going to grow to Mars or grow to some other planet or something like that. But if we have a constraint, either commodity constraints or energy resource constraints, then that's going to translate, that inflation is going to translate into this consumer price index. And we are seeing that where we have energy constraints. We're seeing consumer price index numbers go ballistic in Germany, in the UK, wherever they have energy constraints, their GDP is collapsing because they have to shut things down, and their inflation is roaring higher, which then creates bond market crises. So we're starting to see a bond market crisis, and we're starting to see currencies go kind of crazy. The question is this going to continue, and is it going to spread? I think the answer is yes. And that's why I look at physical precious metals to get yourself out of it. And I think the driver of this is energy related. If you want to fix these problems, if you kind of look at how you try to fix all this, it's got to be supply side driven, I think. And to fix it, we're going to have a lot more energy. So where are we going to get the energy? If we're constrained in oil, and let's say we're tapping out what we can in oil on a global basis, then we're going to have to go to something else. That's nuclear. Obviously, you guys have heard that before. Nuclear can grow, and I think we're going to grow the heck out of it. And it provides stable baseload power. It's the best form of energy in terms of energy returns and mineral intensity of energy that you get back. So I think that we're going to do that quite massively, but there's still going to be a large gap between the money coming into the system and the supply side response. So I think there's going to be an area that is highly inflationary. Will it destroy currencies? That's a good question. I don't know. I think it will. It has the possibility to. And if you kind of look at some of these other guys, like opinions here, we've got Cuppy down here, And here's something I'll go over first. It says the Australian dollar versus the US dollar telegraphing the next big move in precious metals. This chart is more or less the same chart as platinum and some of the other precious metals, but platinum's for sure. And what we're looking at is a breakout, a backtest, and then a move higher for precious metals. Precious metals have gone up every single time this has gone up. It's basically a weaker dollar. When the precious metals are priced in dollars, we're looking at the denominator for going down. The numerator is constant. It's the denominator, the price of the dollar, that matters. So what we're looking at is a declining dollar against other currencies and against precious metals. And yeah, we're setting up for a big move, I think, in precious metals based off of the value of the dollar. Here's weekly trends, just to show you guys information on the housing market. The median listing price, 14%, 13.3. We're up 13.2% year over year. New listings is way down, minus 15%. And our active inventory or listings is increasing slightly. And the time on the market is getting a little bit slower, but it's still at really low levels. It's not anything that is really rocketing higher. So we're still up. New active listings minus 15, and active listings is new listings is minus 15%. Active listings is 34. I think year over year, if you look at that from a year over year basis, I think March 2023 is the time that we're going to see if we go up or down or flat, because that's when the base of it goes way up. So we're going to be dividing by a number that I think is pretty high. Now, this is what Cuppy says. This is what I wanted to go over, and kind of all that information I went over in the beginning here. The question here is, it's not saying to not buy the pause. And he's talking about the pause. What is the pause? Let's go into the pause. The pause is when the Federal Reserve pauses. They can't increase, they don't want to increase the interest rates anymore. And they pause. And that is because they're backed into a corner where they're going to have to make a decision. It's like, if we keep increasing interest rates, we're going to basically tank our bond market, which then if we try to save the bond market, which almost every country tries to save that, they tank their currency. So that's where they're backed into the corner. And if they continue to increase interest rates, they're slowing everything down in the system. They're slowing we'll call it the demand in the system. So if they're trying to slow the demand, that means they have to keep those interest rates at an elevated level for a very long time, as long as the demographic is there with that demand pressure. Now, if they hold those interest rates up there for a long time, that's where they have a problem, because then your debt rolls over and your interest payments blow up. They just blow out. Then they have to print money to cover those interest payments. That's the predicament they're in. That's where they're in the corner, and they can't kind of back out. Because if their payments go way up and they have to continue to print money to cover the payments, it's highly inflationary. And that's the very thing that they want to stop. So they can't stop inflation with increasing interest rates, because then it increases the inflation from the interest payments. That's where they're stuck. So when you look at it from that perspective and you kind of read through this, it says, not saying not to buy the pause, just saying it may be a trap. Of course, energy doesn't care about what's going on. And it says, watch the 30-year here. Everyone is juiced up to buy the pause, but 30-year is saying to be really scared. If we are going to puke, it's now, as everyone figures this out. So what he's trying to say, and what I think I'm trying to basically describe in this video here, is the Fed's backed into a corner. The way that they've been manipulating the short-term prices is through the Strategic Petroleum Reserve to hold the inflation rate down through oil, and the Freeport LNG terminal went down, and they're holding it down through natural gas. So that's the energy prices, which is the number one commodity, is oil. They're holding it down through that and holding that inflation rate down. And they're getting massive inflationary pressures from the demographic in the housing side of things. And we're seeing constraints in the system through GDP of Europe, with an energy crisis there, and constraints through energy. When that SPR release stops and the demand comes back from China and the supply falls from Western energy service companies leaving Russia, which could be a decline of 1 or 2 million barrels, and winter, what we're going to see is a large imbalance in oil, which is going to be highly inflationary. When Freeport LNG terminal comes back online in November, that is also going to add to inflationary pressures for natural gas. So we have these inflationary pressures, and I don't think they can, which is going to hold the interest rates up high for a very long time, and the demographics pushing with an inflationary pressure, which is going to hold the interest rates higher for longer, and the Fed's backed into a corner where they can't do anything. And people are looking at this from the paradigm of old paradigms, looking at interest rates saying, oh, well, we're probably at a top, because they're looking at the inflationary CPI numbers, thinking that we're going to top and go down. But really what's happening is the Fed's backed into a corner. It's probably going to be inflationary no matter what the outcome is, as long as those interest rates stay high. And if we have this imbalance or constraint in energy, it's going to continue to be inflationary. The pause in inflation was due to the Strategic Petroleum Reserve release and the natural gas Freeport LNG terminal going down. That's your puzzle that you have to fit together. And the next question is, when the stimulus kind of works its way through the system, what is that next sustainable inflation rate? Where is that going to settle out? It's going to be driven by the supply-demand balance of housing, the volume of loans coming into the system, and the demographic driving that. And how high those interest rates stay, and the predicament that the Federal Reserve is in, backed into that corner. It's kind of complicated, but that's where Cuppy's mind's at. I think that's where my mind is at. If you go back and you listen to my Palisades interview with Tom, I say the same thing. They're backed into a corner, and he's like, well, how do they solve this? I'm like, I don't know. They're in a predicament. They have to handle an outcome. They either sacrifice something like the dollar, or they have to kill all the demand. It's hard to say. But that's what I wanted to talk about. If you guys need help investing in this, I've got a lot of real good, highly leveraged companies in energy service companies. I also go into some of the precious metals companies. I think there's some good companies there. We've been talking about it, charting it all out. If you guys need help, definitely check out the Platinum membership, finding-value.com. You can go on there. We have a question and answer session today, Sunday, at 5 p.m. Mountain Standard Time. You can ask me questions directly. I can answer whatever I can within the limitations I can, which I can basically tell you what I'm doing and what companies I like. I can't give any financial advice or anything like that on your own circumstances. But, and if you guys like this type of content, give me a thumbs up, subscribe to the channel if you haven't already. I give updates like this, and the things that I'm watching right now is the real estate market, housing starts in particular, the volume of homes coming onto the system. That will tell us if that inflationary pressure is still there. We do have a supply-demand imbalance given the demographic. We do have energy constraints, and we have supply chain problems that are going to further add to, I think, constraints in the system. We also have a lot of constraints in commodities in terms of mines not being developed. We also have continuously lower ore grades coming online with these new mines, which exponentially ramps up energy demand for those low ore grades if we want to produce those metals. Wealth is nothing more than the conversion of energy and commodities into products. That's all it is. Same with food. It's just a conversion of energy. So energy is the number one commodity. It's the thing that drives everything. It's what allows us to do work. It's what allows us to be wealthy as people. So that's what I've got for today. Hopefully, you guys can jump on that Zoom call at today, Sunday, and I'll catch you there. All right, guys, we'll catch you next time. This is Finding Value.